Stocks in the green across the board, with the S&P hitting a fresh all-time high after this morning's better-than-expected June jobs report. What does it all mean for the Fed's rate cut path ahead? Let's ask Frederic Mishkin, former Federal Reserve Board governor. He is also a CNBC contributor, and it's great to see you. I mean, a single monthly jobs report, it's always a little bit of a, eye of the beholder type of exercise. What did today's report tell you? I guess, does it leave you more encouraged about the trend or maybe a little more worried?
Well, as I've been saying, the Fed has a fairly high bar on lowering rates, and this just actually made it higher. And the markets have recognized that. They've dropped their view that the Fed might cut rates in the near future. So there's two elements of the jobs report. One is that it was better than expected in terms of the number of jobs. Also important in the jobs report is the fact that the unemployment rate actually went down. And this is a reflection of the fact that labor force participation, the supply of labor, has decreased. And in fact, the crackdown on illegal immigrants in the country may be part of this, that they're afraid to show up for work. So all of this actually is something that it tells the Fed that they still have to watch out for inflation. There's no crisis in terms of the economy that would indicate that they should lower rates. It's true that the Fed policy is a little bit restrictive, but that's sort of appropriate right now. And it's a wait-and-see attitude. And they want to basically have a lot more information to tell them that they need to cut rates, and it's not clear at this particular point in time.
Yeah, I mean, I'm sure you've heard, or if not just today, then previous, Treasury Secretary Bessent essentially saying, that right now the conditions fit all the Fed's previous criteria and its models for cutting rates at the moment, and why aren't they doing? I mean, now, of course, PCE has not been to 2% yet. It's not as if it's been at the target and they're ignoring that. But what do you say in answer to that point?
Well, I actually think that, there's a viewpoint that's coming from the Trump administration, which is the only good interest rate is a low interest rate. That's very much part of Trump's view of the world. He's a real estate guy. They love low interest rates. They never like high interest rates. I have a nephew who's in real estate, and he always berates me when I actually think that rates should not be lowered or should be actually raised. So the issue here is that there's a lot of reasons for the Fed not to cut rates at this point, which is, number one, is that the inflation, they are very concerned about inflation expectations rising for several reasons. One is that the tariffs are in place. They haven't been eliminated. All these deals that supposedly were going to lower tariffs haven't materialized yet. And in fact, we haven't yet seen the effect of tariffs on inflation yet, and that can take some time. So the Fed's very concerned about that. The second issue is that the Fed has, in recent experience, actually blew it a little bit. They allowed inflation to rise and get out of control, and that weakened their credibility somewhat to control inflation. And they have to keep that credibility in place. It's extremely important to them to do that. And in fact, research shows that having strong credibility to keep inflation under control is something that actually makes monetary policy more successful. So they don't want to give that up either. The bottom line is the economy is still at full employment, that the labor markets are still reasonably tight. Nothing there that's actually going to cause inflation to go down very much. And of course, the Fed hasn't met its target of 2%. So all of those things are actually very important in their decision making and indicate that there's no rush to lower rates. And in fact, if things could go the other way, very strong economy, inflation rises, they could even actually contemplate raising rates, although I think that that's a very, very unlikely at this particular point in time.